Most people don't think rates are high because of math. They think rates are high because of memory. They're anchored. They're anchored in the past, anchored to what rates used to be, anchored to what they saw their parents pay, anchored to what their friends bragged about in 2020 and 2021. Anchoring is one of the most powerful psychological forces in decision making. And in housing, it quietly ruins more decisions than almost anything else. Anchoring happens when your brain picks a reference point and refuses to let go of it. Once that reference point is set, everything else feels wrong by comparison. For buyers today, that reference point is artificially low rates, 3%, 2.5%, sometimes even lower. Those numbers are burned into people's brains, not because they're normal, but because they were recent. And recency bias is strong. Here's the uncomfortable truth. Those rates were not the baseline. They were an anomaly. They existed because the economy was under emergency intervention, massive stimulus, zero rate policy, asset purchasing at scale. The environment does not represent how mortgage markets typically function. But once people experience something, they assume it's how things should be. That's anchoring. So when rates return to historically normal levels, people don't say, this is normal. They say, something is wrong. Here's the thing, nothing's wrong. Your reference point is, historically speaking, mortgage rates is 6 to 7%, not extreme. They're boring, they're average. They are where markets often live when inflation exists, growth exists, and money has a cost. The problem is not that rates are high. The problem is that expectations are distorted. And distorted expectations create paralysis. People don't ask, does this payment work for my life? They ask, what can I get what someone else has got 3 years ago? The question is absolute poison because you can't buy in the past. You can only buy in the market that exists today. Anchoring also causes people to misunderstand risk. When rates were low, risk felt visible. People stretched because they could. Payments stayed manageable even when prices were aggressive. They created a false sense of safety. Now that rates are higher, risk is visible again. Payments feel heavier. Decisions feel more serious. That doesn't mean that the market is worse. It just means the market is honest. Another mistake anchoring causes is emotional comparison. People say things like, well, my coworker bought their house at 3%, or my neighbor refinanced at 2.5%. Those statements sound factual, but they're actually very emotionally loaded because what people are really saying is, I missed something. The feeling of missing out creates regret, even when no mistakes were actually made. Here's something important to understand. Every buyer benefits from something and sacrifices something. The buyer who got a 3% likely paid a higher price, way more competition, more heartache, waived contingencies, higher stress. The buyer today may face higher rates, but more negotiating power, more concessions, more control. Different environments, different trade-offs. Anchoring makes people see only what they missed, not what they avoided. Another way anchoring shows up is in affordability conversations. People say, I can't afford a house anymore. What they actually mean is, I can't afford the house I want at the payment I imagined. That's not the same thing. Affordability is not binary, it's adjustable. Prices can change. Again, structure can change, location can change, timelines can change. Anchoring freezes flexibility. People get locked into one version of what buying should look like, when the reality is it just doesn't match up. They stop exploring options. That's how people talk themselves out of viable paths. Another issue anchoring creates is delayed action. People say, I'll wait till rates go back down. But what they're really saying is, I don't want the world to return to the version I'm comfortable with. Markets don't work that way. Rates may go down. They may not. Prices may adjust. They may not. Waiting based on nostalgia is not strategy. It's resistance. Smart buyers adapt to the market they're in. They don't argue with it. Anchoring also causes people to misjudge the opportunity. When rates are low, opportunity feels super obvious, right? When rates are higher, opportunity feels hidden. But opportunity doesn't disappear, it just changes shape. In a higher rate environment, competition thins out. Sellers negotiate. Terms matter more than speed. Creativity returns. But you only see those opportunities if you're not emotionally stuck in the past. Very, very difficult to achieve, I realize. Another problem with anchoring is that it exaggerates the importance of rate relative to everything else. Rate is important, but it's not the only variable. Payment is what you live with. Payment is influenced by price, down payment, structure, buy downs, which are a huge thing in today's market, term length. Anchoring also causes the rate to adjust. People ignore levers they can pull. They obsess over the one lever they can't fully control. And that just creates absolute frustration, which frustration creates inaction. Inaction creates regret. Another subtle effect of anchoring is that it turns education into noise. When people are anchored, they don't actually hear information. They filter everything through comparison. You can explain structure, strategy, and long-term planning, and they still come back to, but the rate is higher than before. Well, that's not a rational objection. That's just emotional resistance. And until that's addressed, no amount of data helps. That is why understanding psychology matters in mortgage decisions. Buying a home is not just a financial decision. It's definitely an emotional one, layered on top of math. If the emotional layer is distorted, the math never gets a fair hearing. Here's a reframe that helps. Instead of asking, are rates high? Ask, what does today's environment reward right now? It rewards preparation, negotiation, flexibility, patience. It punishes rushing, overstretching, and emotional bidding. Ignoring structure, that's not a broken market, that's a selective market. And selective markets reward people who think clearly. Another truth most people don't like hearing is if rates return to 3% tomorrow, affordability would not magically improve. Demand would surge, competition would explode, prices would likely rise again. You would be trading rate pain for price pain. Anchoring makes people believe lower rates are a free win, and they're just not. They're a trade. Every benefit comes with a cost. Another place anchoring shows up is in long-term thinking. People anchor to today's discomfort and assume it's permanent. They forget that income changes, careers progress, skills compound, household income often grows over time. A payment that feels heavy today may be manageable in 5 years, but if you anchor to today's feeling, you assume that it defines the entire future. And that's really rarely true. That doesn't mean that people should stretch irresponsibly. Absolutely not. It means they should think dynamically. Static thinking kills good decisions. Dynamic thinking creates resistance. Another dangerous belief anchoring creates is that buying later is safer. Later is not inherently safer. It's just not. Later often means higher prices, less inventory, more urgency, fewer options. Earlier, when done responsibly, often means more flexibility, more opportunity to refinance, more time available to you, and time is probably the most powerful asset. Anchoring makes people undervalue time because they're fixed on a rate, but time is what allows adjustment. Refinancing requires time. Equity requests time. Income growth requires time. The earlier you start responsibly, the more time you have working for you. Here's another important point. People who anchor to low rates often underestimate the emotional cost of waiting. Watching the market, watching rates, watching prices, they're constantly monitoring, and that creates anxiety, or for some, excitement. Anxious people don't make good decisions. They tend to freeze, overreact, second guess, and in that circumstance, clarity removes anxiety. Clarity comes from understanding, not nostalgia. So here's the core truth. Rates are not high or low in a vacuum. They are simply what they are relative to the economic environment. What matters is whether the decision fits your life. If the payment works, if the structure is flexible, if the risk is understood, those things matter in every rate environment. The buyer who succeeds long-term are not the ones who got lucky with timing. They're the ones who avoided anchoring. They adapted instead of resisting. They accepted that markets change. They didn't demand the past return. They made decisions based on reality. That's the difference, in my opinion, between people who move forward and people who end up staying stuck. Anchoring gets people emotionally attached to a world that just no longer exists. Understanding that frees them to operate in the one that does. And once that mental shift happens, decisions get clearer. Not easier, clearer. Clarity beats comfort every time.